Jitendra Sriram, MD and Head of Research at HSBC India now joins in. Jitendra, hi, good morning. First up, would it be fair to expect a pre-budget rally and maybe a continuation of that after budget, or should market now prepare itself for a bit of a disappointment and profit booking?
Well, I would argue that two things are going to have a lot of relevance to market in the coming fortnight or so. First would obviously be the monsoons, and there is a lot of concern around that. In a sense, there's already reports that June monsoon has been one of the worst in probably a century or so, or probably one of the lowest in the last century. And I would reckon that that is going to have a lot of bearing as market observes whether there is some catch-up coming through in the first fortnight of July. So that's going to have a lot of influence, and this is extraneous to the budget. The second would also be the lot of noises that have come through from the administration ahead of the budget that people need to tighten their belts, they need to, as we try to move away from this kind of lot of subsidies that have been prevalent in the system to more towards an investment cycle recovery, I would expect there will be some degree of shift in policy environment away from the path to where we want to be. So I would still suspect that the budget could be a little tighter, and also bear in mind that this is the first budget of the new government. They would actually like to create a platform which will probably facilitate better medium to long-term growth rather than try to do something which is more populist right at this point of time.
But will that not be taken positively by the market, Jitendra? Because if we do see a populist budget, then the market will sell off. In case, there is a tight budget where there is a resurrection of fiscal responsibility, etc., don't you think all of that will be taken well by the market?
No, definitely. See, the question is only about what is the tenor that we are looking at. I don't dispute at all what you say that, market will obviously view that much more positively, especially if there is a lot more of fiscal consolidation, there is some degree of moving away a lot of the social spending to productive areas of the economy and so on. But having said that, do bear in mind that market is already up 18% year to date, and a lot of it is still sentiment driven. I don't think there is a commensurate improvement in corporate financials thus far. And then you have the situation where you could have some fiscal tightness coming in because of the issue related to this fiscal consolidation, which means slightly more taxes, slightly better spending patterns and so on. And at the same time, you will have a weak monsoon, which means that monetary policy will likely be stronger for longer. The conjunction of both of these things cannot be very positive for corporate earnings near term. So the shorter term, you may actually be heading for a small disappointment, although we do set up the medium-term platform going forward. So I would still say that, expectations for the short term might get dampened a little bit, whereas, the longer-term outlook for obviously the economy turns around. So I would still expect that, budget will be probably less of the focus on the numbers at this point of time, probably going to be much more in terms of the statement of intent of what are the priority areas of the new government going to be.
Jitendra, let's talk about some of the market leading sectors then. Oil and gas clearly has been the big support for this market. How are you approaching that space? Because last week you had the news of deferral of gas price hike, but yesterday you had that big petrol price hike and that continuation of diesel price hike. In light of the news flow regarding what's happening to crude and what's happening domestically, how would you approach this space now?
Yeah, I would argue that, from a petroleum pricing environment, I don't think petrol now is a needle mover for the sector, because it is by and large understood by the market that we will be close to parity, give or take a delay of a fortnight or a month. Will probably come back to parity on pricing in terms of petrol prices. So I don't think that influences market sentiment too much now. Diesel, we need to continuously see this half a rupee uptick continue to come through for the next couple of months at least, till we beat down this under recovery which is currently existing. And also it's been worsened in the near term by the spike in oil prices because of the situation in Iraq. Now, I think the big thing that the market would be awaiting is does the government have the stomach to do something on the tougher parts of petroleum pricing, which then brings you to the domain of kerosene, cooking gas, then in terms of fertilizer pricing relatedly. So I would suspect that the easy part of the story is broadly done. Now we have to attack the tougher parts of what can further catalyze this sector from here on. So some kind of measured pricing increases there will be taken positively, but in case there is nothing forthcoming on those areas, you could see that probably you might head into some kind of profit booking on that sector then.
You know, I've been meaning to ask a lot of market experts on what their expectation is from the tax bit this time around. And you just made a reference yourself to the possibility of widening of the tax net. There could be a reduction in the, you know, exemption of indirect taxes, etc. If that comes through, how do you think the market will react?
Well, on the tax issues, I think, tinkering with a few amounts of duty rates or some degree of excise rates will not be too material, because end of the day, because of the modvatable nature of excise, etc., the net impact is usually quite modest. You know, obviously in certain sectors which are highly taxed, like say autos, etc., tax cuts do make some kind of a difference in terms of consumer sentiment, probably triggering some kind of buying decision and so on. But I would say that, you know, a lot of attention would be in terms of a stable regulatory regime, like for example this retrospective taxation, which the government has been quite candid that they would like to avoid that, to encourage confidence among foreign investors, how they tackle issues of trying to look at transfer pricing arrangements. These could be far more critical in terms of inducing foreign investments to come into the country, rather than this small tinkering in terms of tax. It is going to be a little difficult here, especially if monsoon pans out the way we are seeing it right now at the end of June. So if that be the situation, I would not bet too much on tax cuts as the way forward, because government will anyway be strained for resources. So I would still say this will be a year of repair rather than too much of positive news coming forward on the tax front.
Okay, so in effect, if you believe that in the short term this market may see some disappointment and in the longer term things are still intact, then what would you assess as the market levels by the end of this year, or say by the end of FY15?
Well, for this year, I would still, look at markets being more flattish, because I do sense more risk coming from this issue of monsoons more than the budget, and then obviously the issue of combination of tight fiscal accompanied with a continuing tight monetary policy into the end of this year. So I would more look at flatter markets this year. But do bear in mind, market will continue to compound probably by another 14 to 15% as we forecast it at this point of time at an aggregate level for next year. So hopefully that should be, even if there is no material rating improvement, I would suspect that the market should at least track earnings growth going forward.
All right, let's get in a query posted on our money control message board. Abhishek Deshpande writes to us from Indore. He wants to know if the weak monsoon and weak fiscal situation could affect the budget in terms of leeway the finance minister would have if the conditions were in his favor. Jitendra, what's your call on that?
Well, I would definitely suspect so, because if you have a situation of a weak monsoon, then the priority will obviously be a lot more socially oriented, whether because the rural income level will go down because of a weaker crop output and various other things, you could have some kind of more relief coming through there, which means that whatever you had anticipated in terms of fiscal consolidation this year may not all be achieved this year given the failure in the monsoon. So to that extent, I would still say that it will impact freebies or some kind of sops being given on the other side of the story.
Okay, Jitendra, the other bit is how do you approach this market in terms of your portfolio allocation, especially after budget and in the second half, because the first half has been all about high beta and cyclicals. You've seen defensives do rather poorly. Would the second half be similar along those lines? So would the cyclicals still remain the leaders of this market?
Well, I would say that one will need to turn a little bit more selective, because what is happening is that one of the factors is, Clearly, one will need to see from the budget what are the main priority areas of the new government that come in, which will influence some degree of positioning. Now, supposing that they do, go along the path of, talking about much more defense indigenization, stuff like that, which, the manifesto talks about. They have talked about it in terms of some of the announcements that have come through in their first month in office. I would say that that will obviously be the investment side of the story, something which is clearly going to merit some attention going forward. Secondly, I would say that, metals names would obviously be an area which could potentially do better in case there is a domestic investment-led recovery. Having said that, where I think caution would be also required is there is a lot of fundraising. In fact, if you look at it in the last 1 month itself, there's been quite a decent amount of fundraising. Now, in case there is this magnitude of fundraising which continues and it's going to be topped up with Government of India disinvestments, some degree of, also maybe spectrum auctions, coal block auctions, stuff like that, incremental appetite which flows through to secondary market will be a little less, than what market anticipates it to be. And to that extent, I would definitely say that, just playing high beta for the sake of high beta may be fraught with risk. One will constantly need to evaluate in terms of how the earnings stream comes through and probably have a much broader bearing on the earnings front right now. I would say that earnings is like a report card for the company. So, sentiment driven rise can only take you that far. Beyond that, earnings have to start coming through.
All right, we have one more query coming in on our money control message board. Jitendra, Varsha has written to us from New Delhi. She wants to know if banking stocks are the best bet currently. What's your view?
Well, on this, I would put it in two buckets, the private and the public space. I would say that on the private space, the kind of things that are coming through are slightly different from the public space. Public is all about asset quality, if one really believes that, over the next 2-3 years, there will be a strong recovery in the economy. Obviously, I would suspect that asset quality will slowly start turning better, which should hopefully improve the valuations for these names and so on, which is the story that is playing out there. Now, the second part is the private. I think there the bigger issue is on ownership levels constraints. Whether we look at FII restrictions, a lot of stocks are now going into areas which are now getting restricted for foreigners to buy. So, we are seeing the FII pad open up. We are seeing, a separate window being created there and so on. Now, the issue that can materially change here and which could happen in the budget probably is this entire crashing of all sublimits within the overall FII FDI limit. If you make it one homogeneous limit and then argue that, everything within that is fungible, it could be a big catalyst for the private sector banks. And that can be quite a big trigger because it will suddenly create a lot of appetite for foreigners to buy into these banks.
Okay, Jitendra, we'll leave it at that. Thanks for joining us and giving us your view. So that's the word coming in from HSBC on what they expect this time around in the budget and the sectors that you should be watching out for.